There's a lot of nervousness out there, a lot of debt out there. Hey, maybe the Fed has waited actually too long to cut rates, and as a result has applied some downward pressure on the economy. And I think you're going to have a very significant Fed pivot coming up in September. Those two things I think are going to continue to drive gold.
We're talking about safe haven assets to look into during times of extreme volatility, a very timely subject given how much volatility we've seen in the markets over the last week or so. Levi Gunter joins us today. He is the sales and marketing manager of OneGold, and we were talking about gold and silver. Welcome to the show, Levi. Good to see you.
Likewise. Thanks for having me on, David.
Over the last couple of days, there's been significant volatility, as you know, in all markets, including gold and silver. Silver's been down about 7% since its highs, and I'm looking at gold down about 4% off its highs in early August, late July. Now, this is normal. Usually during extreme sell-offs, we see all assets correlate to one on the downside. How are you feeling about the gold and silver price overall, despite this sell-off?
Yeah, great point. Overall, I still feel pretty good about it. I mean, as you mentioned, gold and certainly silver have never really been immune to kind of the sell-offs, and certainly the sell-off that we're seeing right now in the broader market. So I'm not surprised necessarily. If anything, I think it sort of creates a buying opportunity for those who are looking to get in.
Why is there this sell-off during extreme sell-offs for gold and silver? You know, generally speaking, a lot of investors consider gold in particular a safe haven play. But as we've seen in prior periods of volatility, gold tends to sell alongside equities, and at least the initial phases of a correction. Why is that, do you think?
Yeah, I think you really hit it there. So it's really, from what I can tell, more in the near term, right? So in terms of a sell-off, there's nothing's off limits, right? So folks are basically selling everything. And if that's correlated with sort of an economic downturn or a recession or what have you, oftentimes that environment long term rather is sort of supportive of precious metals. So what we often see is, gold and silver will decline amid sort of a sell-off, but then long term tend to recover as sort of buying interest kind of reinvigorated over time.
What's your interpretation of events over the last week? Extreme selling and spiking of the VIX in the U.S. markets. Overseas, Asian markets saw extreme volatility as well, with the Nikkei down 12% on Monday, then bouncing back 10% on Tuesday. What's driving this volatility, you think?
I think there's a lot of nervousness out there in the market, right? So, you've got concerns regarding the U.S. dollar and the direction there. A lot of people for a long time have been under the impression that sort of stocks have been to some degree disjointed from reality, and we're kind of due for a correction. So I think there's a lot of nervousness out there, a lot of debt out there as well. And when you combine those things, I'm not particularly surprised. Looking at precious metals, like you mentioned, not immune, but so far gold's had a pretty good year. Throughout 2024, it's had multiple drivers. I think certainly in the expectation of interest rate cuts, you've had robust central bank buying, and I think most significantly geopolitical developments, especially in the Middle East. And I think as we're talking today, you mentioned gold's down a little bit. I believe it's up about 16% year to date. And prior to that, it's achieved multiple all-time highs, especially in the second quarter, March, April, May, and I believe even more recently in July. And a lot of gold's more significant upticks can be correlated, at least this year, directly to geopolitical developments, especially in the Middle East. And so what we've seen since then is, gold has retraced to some degree. I think that gold has, to some degree, become sort of a victim of its own success, right? And that's to say that higher spot price has equated to a lot of profit taking by investors, price sensitivity in other sectors. For example, I know it was reported back in May that the Chinese government paused their 18-month buying spree of gold. So certainly you're having some profit taking and price sensitivity there. But, if I'm looking forward, I do think that gold still has two very distinct drivers for the rest of the year. I mentioned geopolitical items earlier and also monetary policy. So firstly, on the geopolitical side of things, unfortunately, I don't really see a slowing of some of the conflicts that we have going on right now. Obviously, there's still a conflict in Ukraine, albeit we're not hearing about it as much in the news right now. You've got tensions between the United States and China, especially as it pertains to Taiwan, and more broadly speaking, the East and the West. And then, obviously the conflict in the Middle East. And regardless of how you feel about any of these conflicts, none of them seem to be kind of closing in on a quick or concise ending, kind of reading the tea leaves, rather, even if you just look at sort of Israel's stated goal in Gaza, it's the degradation of Hamas as a governing authority there and the recovery of hostages that were taken back in October by Hamas and other armed groups. So certainly, if you're looking at that, you're not seeing a quick end in sight. Again, unfortunately, as it may be, that's likely going to continue driving gold, in my view, for the rest of the year. And you have the Fed conversation as well, monetary policy. You've got this long-awaited Fed pivot that is coming up likely in September. And I think it's important to mention that that's a pivot in more than one way, right? So we're pivoting in the sense that we're going to likely embark on a rate cutting cycle, but also it's a pivot in the sense that the Fed is abandoning this narrative that they've been tied to for the last couple of years that said, hey, we're not going to cut interest rates until our measure of inflation, PCE, is at or below the target of 2%. Well, clearly we're not there in terms of inflation. We're well above that, and we're about to cut rates here in September. I think I checked the CME Fed Watch tool earlier, and it was still giving a 100% chance of a 25 basis point rate cut in September. And you mentioned the economic kind of backdrop now, and you've got some people sort of thinking that, hey, maybe the Fed has waited actually too long to cut rates, and as a result has applied some downward pressure on the economy. And they may have to actually pursue a more aggressive rate cutting policy. So all of that being said, I think you're going to have a very significant Fed pivot coming up in September. Those two things, I think, are going to continue to drive gold. So I've got a bullish outlook. I think it's tempered to some degree for gold because, again, you have that price sensitivity kind of setting in for some central banks and in other sectors. But overall, if I'm looking at gold for the rest of the year, I wouldn't be surprised. I have a little bit more of a conservative estimate, probably 18% higher, which is still a great year, which I think puts it at around 2450 by year's end.
Are you expecting the economy to deteriorate then if you're still bullish? 18% upside from $2,400, which is what we're sitting at the time of the discussion today?
Yeah, I mean, certainly I wouldn't be surprised by that, whether it's a recession or something worse. I'm more so basing that off of sort of geopolitical developments and monetary policy. But, a lot of those things are tied together. So, yeah, I certainly wouldn't be surprised.
In terms of monetary policy, can you just explain in layman terms why perhaps a Fed cut or lower interest rates in general have been positive for gold? Keep in mind that gold has in the past been inversely related or correlated to real interest rates.
Sure. Yeah, I mean, gold's a non-yielding asset, right? So it's going to be beneficial when interest rates are lower. And so you often see that, gold's pretty reactive to monetary policy, especially when you've had a long time of an elevated sort of interest rate environment, and you sort of start to cut from there. Gold typically reacts positively to that.
One thing that did break down this year was the positive correlation between inflation and gold. Now, in the past, during some periods, there have been positive correlations or periods where gold and inflation have moved up together in tandem. This was the case in 2021, for example. Inflation this year has been trending down. It peaked last year about 9.1%. It's been coming down all the way. The latest reading of headline CPI is 3%, yet gold has moved in the opposite direction.
Yep.
How would you interpret this breakdown in this relationship?
Yeah, that's a really good question, because intuitively you would think that with higher inflation, the well-known inflation hedge, gold, would certainly outperform. And I think you find long-term, sometimes that's the case, but often when inflation is running rampant, you've got a more hawkish monetary policy, so interest rates are increasing. You can draw some parallels. You could look at, the mid 1970s when the Fed thought they had inflation sort of tamped down, and there was actually sort of the second wave of inflation. And from about 76 to 80, gold increased by about 300%. And you saw some stickier inflation ratings, over the past couple of months. And I'm not saying that's going to happen now, but I do all that to say I think that certainly gold may not perform like you think it would intuitively in the near term, but long-term inflation, typically is not necessarily a bad thing for gold prices.
And I want to show you and share with the audience a chart here. This is the US dollar versus gold. So gold is the orange line, the US dollar is the bar chart. And you can see year to date, there's been an inconsistent relationship. Gold has historically been marketed as an anti-dollar asset. As we've seen this year, volatility has more or less broken down this relationship. So how do you expect this relationship to progress going forward? Recently, a huge drop in the dollar, while gold has maintained relatively steady. And during periods throughout this year, we've seen gold not move up as much when the dollar, went down. So, there have been periods where they've both moved down together. It's interesting.
Yeah.
So how are you interpreting this relationship now?
Yeah, that's another good question. So, again, historically, you could almost say that the dollar and gold have been correlated. Things have been different over the past several years, especially. I more so attribute that again to kind of the higher interest rate environment where, again, gold's sort of a non-yielding asset. So when you're competing with higher interest rates like that, I'm not sure that you could really count on gold to perform like it may otherwise when the dollar isn't necessarily performing, at least in the near term, if that makes sense.
And we talked about where people in the industry have talked about Chinese buying of gold, central banks as well as retail demand. I believe Chinese investment demand has been up 68% year over year.
Yeah.
Was this a significant factor, Levi, in the drive up of the rally?
Yeah, I think so. More so, I believe the central bank buying component. And, like I mentioned earlier, you're probably going to see that slow to some degree. I know the World Gold Council actually released some pretty good data surrounding both, central bank purchases and retail kind of demand for precious metals. And you're seeing some interesting trends there. So I believe 81% of central banks that responded to the survey mentioned that they planned on increasing their gold holdings over the next 12 months. So I certainly attribute it to central bank buying. I know jewelry buying is also a big deal in China and India as well. Again, another report from the World Gold Council kind of outlined sort of an interesting trend there. Like in Q2 of this year, jewelry demand actually declined by 19%. And mind you, jewelry demand is a significant contributor to gold's overall demand. And while jewelry demand declined, you had an increase in both central bank demand and what they call OTC or over-the-counter demand. So that's coin and bar demand from high net worth individuals, institutional investors, family offices, so on. So to me, that kind of highlights an interesting trend that says, yeah, there's some price sensitivity, especially in the jewelry markets, but investors are still viewing gold as that portfolio diversifier, even amid sort of the higher prices.
Okay, I want to move on and talk about silver now. So let's show a chart of the silver price year to date. It's done really well. If you just draw a trend line, year to date, it's up around 20%. It's down a lot from its highs, though, broadly in line with the sell-off in stocks, right? It's down about 17% from its top. And if you correlate this with the copper price, actually, there's been a close correlation with the other industrial metal, copper. I'm just going to pull this up. And you can see how they've kind of moved in tandem all year round. Is this surprising for you?
Yeah, to be honest, I mean, not necessarily. We don't deal a lot in copper at APMEX or OneGold in general, but I'm not surprised to see that they're correlated, right? So silver's got that industrial component. So in a given year, at least recently, the industrial demand for silver has accounted for, a little over half of silver's total demand. And so copper also is an industrial metal. I'm not surprised that, the two are correlated.
Is that signaling a recession, you think, this decline?
It certainly could, yeah. So that's kind of the interesting thing about silver, right? So pivoting a little bit to silver, at one point, it's had a lot of volatility this year. At one point, like you mentioned, I think it was about 25% higher year to date, which would have been in May. Right now, it's a little bit lower, like gold. It's given back a lot of those gains. And yeah, on one hand, it's easy to make the bullish argument for silver based off of the industrial component. Like I mentioned, it accounts for a significant amount of silver demand. And even recently, the Silver Institute forecasted that industrial demand for silver is supposed to increase by about 9% this year, which would actually widen the overall physical silver deficit to its widest or its most significant, rather, in 20 years, which would be about 215 million ounces. So on that side, you kind of have a bullish argument for silver. But on the flip side of the coin, you can make the argument that says, yeah, if you anticipate any kind of economic downturn or recession, this is almost certainly going to dent, industrial demand for silver. So you could make both arguments there, and I would certainly think that a downturn in the economy is going to dent industrial demand and subsequently overall demand for silver.
So if the economy slows down and people rush to a safe haven asset like gold and perhaps less demand, perhaps demand may wane for silver. Are you expecting the gold silver ratio to widen, Levi?
Maybe initially, I think you often see that, right? And the gold silver ratio is an awfully interesting topic. So, that's something that's been around for thousands of years. I mean, the ancient Egyptians used it, the Romans, but all that to say, I think you have to consider it in sort of the right context. I look at the gold to silver ratio, sort of the average, anything basically after 1971 up until this point. And why 1971? Well, that's, just after we left the gold standard, and it's after we established gold and silver futures trading. So those two fundamentally changed the gold and silver market to where you now had an average of about 60 for the gold to silver ratio. So certainly I look at that as an indicator. I think right now it's probably closer to 80. And in my mind, it flashes, again, not investment advice, but for me personally, when silver makes it up to the gold to silver ratio, rather, makes it up to about 90 and beyond, that signals to me a good kind of time to buy silver. And we saw that, I think, earlier this year. It made it up to about 94, the gold to silver ratio. Silver jumped by about 20%. And the last time I remember it doing that would have been probably in the fall of or August of, I think, 2022. Again, gold to silver ratio jumped to about 95. Pretty quickly after that, silver jumped by about 25%. I think the gold to silver ratio has been over 100 at one point, and that would have been like the first quarter of 2020. So, just right when COVID hit and silver was about $11 an ounce. So you do certainly, to answer your question, kind of see that widen, I think, in the initial stages of things. And then it tends to kind of normalize over time. So all that to say, I do value the gold to silver ratio. I just look at it in sort of a certain context.
Being a gold bullion dealer, OneGold has its, it has real-time data on what buyers and sellers of physical gold are doing. Yeah. So what's been going on over the last week and a half with a lot of volatility? Are people more interested in buying or selling silver and gold, by the way?
Yeah, I'll just kind of answer both because it's essentially the same. APMEX and OneGold, the past, I would say, couple of weeks, amid all of this volatility, we've certainly seen an uptick in sales. No doubt about that. Overall, though, we have seen, again, on APMEX and OneGold, sort of a normalization of sales. So we're kind of looking at kind of pre-pandemic levels of sales, still healthy, but not really kind of the record quarter after quarter, year after year that we sort of grew accustomed to after 2020. So while sales have been sort of declining, we've actually noticed a trend where buybacks have actually dramatically increased. And I'm thinking back to the fall of 2022, once again, believe it or not, gold was at $1,600 an ounce at that point. So ever since then, we've consistently seen buybacks trend up with spot price. And we actually saw that peak probably in March of this year, when APMEX buybacks were about 40% of their total sales revenue, which, for context, APMEX does about 1.5 billion in sales every year. So quite significant. So really, yeah, overall, to answer your question, the past couple of weeks, I've certainly seen sort of reinvigorated interest in buying. But overall, that trend has been, folks are really taking advantage of this higher spot price and taking a little bit off the table.
And how have premiums evolved over the past couple of months with gold reaching new all-time highs several times this year?
Yeah, so I could probably speak a little bit more on the buyback side. So really what we've seen on APMEX. So for context, APMEX is a large physical metals retailer. So they're buying and selling gold and silver, coins and bars. And pretty reliably over the past couple of years, you could, basically demand a premium for sovereign coins and production gold and silver. You could at least sell it for spot. Now, a lot of those things currently are selling for a little bit below spot. There's just the market's sort of saturated right now. And so that's kind of a trend that we're seeing, at least on the buyback premiums. For OneGold, it's a little bit different because, we're basically selling wholesale product to the retail public. So we sell 400 ounce and kilo gold bars in various vaults around the world. And those premiums have been relatively steady, where we charge, about 80 basis points for gold if you buy it, and about 30 basis points if you were to sell it back. And so those premiums really haven't changed over time. So I've seen a little bit of a trend where buyback premiums have declined on the APMEX side, but OneGold we're really pretty steady there.
Do you see this trend changing anytime soon in the future?
So in terms of APMEX, I could see, we're starting to see a little bit of a normalization in terms of premiums. So that's been going on the retail side. So for things like gold and silver, American Eagles, Maple Leaf, sovereign coins, premiums have been pretty elevated there for a while now, really since COVID. And that's for a variety of reasons. You've had supply constraints, you've had interruptions at the mints, all-time high demand at various periods. And a lot of those things have started to normalize recently. So I do think you're seeing premiums overall kind of climb down. And I would probably anticipate that to continue, at least from what I could tell, for, hopefully the rest of the year. I like lower premiums. I'm a physical buyer myself, but when I see higher premiums, I tend to, go elsewhere. And, I think certainly vaulted investments like OneGold are a good idea. Not a sales pitch by any means. There are a lot of similar products out there, but that's kind of one of the reasons a lot of our customers have kind of gravitated towards some of that vaulted assets, is just kind of that premium aspect of things.
Well, I'm curious what your customers have primarily been interested in this year in terms of products. Well, first of all, let's walk over your product offerings. Is it primarily U.S. mint products, or do you also offer Canadian mint, Australian as well?
Yeah, so APMEX has a wide variety of products. I believe they're the largest physical retailer here in the U.S. I could speak kind of high level about what they do. They own the company that I run called OneGold. So high level, yeah, I mean, some of their products consist of everything that you listed. They've got basically 30,000 different SKUs. So anything from gold and silver, American Eagles, Maples, Krugerrands, everything that you could think of. And then some of the things that you don't think of, like numismatics and some things like this. So they carry just about everything that you could ask for.
Can you comment on what people have been more interested in this year?
At a high level, certainly gold. So APMEX and OneGold both tend to sell a little bit more gold than silver. So I would say it's probably about, 60-40, at least for OneGold. And so people really kind of gravitate toward that known like monetary metal. If you're looking at APMEX, your most popular products remain your sovereign U.S. mint coins, so gold and silver American Eagles. And that's probably a function of us being a U.S.-based company. They're very recognizable coins. And then after that, obviously, Maple Leafs become very popular. And then you have sort of the production gold and silver items. So, bars and rounds.
There's been a trend of tokenizing real assets, including physical gold and silver. Is that something you're looking into?
That's actually a really good question. We've not really explored that. So with OneGold, we thought maybe there would be some crossover there between sort of our offering and crypto, right? And it turns out they're still different assets. Nothing against crypto or Bitcoin at all. They're different assets. I view crypto and Bitcoin as more of like a risk on asset, highly correlated with tech stocks, right? And gold and silver, not so much, more viewed as a hedge against inflation, a wealth preserver, things like this. So I think they kind of serve a different function in the portfolio. And as a result, have kind of, at least for us, attracted a different clientele, not as much interested in kind of the tokenization of things, but Yeah, I hope that answers your question.
So overall, then, what is your strategy for OneGold in terms of growth, medium term, long term?
Yeah, great question. So, for background, OneGold was launched about 6 years ago. It was launched by APMEX, which I spoke a little bit about, and Sprott. And I'm sure a lot of your audience is familiar with Sprott. They're a well-known alternative asset manager out of Ontario. And I think they have something like 30 billion in assets right now. They're mostly well known for gold and silver ETFs. So the goal with that was you wanted sort of a middle ground between the traditional offering that APMEX had and the convenience that ETFs and Sprott offers. So the intent with OneGold was to have more modern, kind of cost-efficient means of precious metals ownership. So customers on OneGold can simply download our mobile app or create an account online and buy vaulted metal and store it here in the US, Canada, Switzerland, the United Kingdom. It's fully insured and audited. And essentially the goal with that, though, was, again, to improve the traditional experience. So we wanted to cut down on cost. When I buy metal, I want to invest in the metal, not the premium. So that's been a part of the strategy, certainly, is to offer a more cost-efficient product. We wanted a more modern product as well. People have been investing in precious metals for an awful long time now. And we wanted to offer some features that are reflective of kind of where we are now. So we offer the bullion card, which is a credit card where you can earn precious metals as rewards. Things like auto invest, where you can automatically buy over time. Limit orders, which allows you to execute a buy or sell transaction depending on what spot does. So again, the goal there was just to sort of give you the best of both worlds between direct physical ownership and what you can get in an ETF. And that's kind of been the goal with OneGold.
Gold has traditionally been owned by, I would say, older retail sophisticated investors. How would you market your product or any gold product to a younger Gen Y or Gen Z audience?
Yeah, really good question. So that's been, that's really our demographic, right? So we certainly have that 55 and plus affluent demographic. But I think it really boils down to, for the younger generations, education and telling that story. A lot of them are interested in crypto, and I think you've got to sort of, appreciate that, but also highlight that they're two different assets. And you also have to highlight that, a lot of folks who are pretty young, Gen Z and such, they haven't really experienced a prolonged bear market, right? And so you really kind of want to highlight these things as to why you may want to own gold, how you can own gold in more of a modern manner. So to answer your question, I think it is certainly a challenge. Our demographic is that 55 and plus, but in order to sort of target the younger generations, I think, in short, it boils down to education.
I've always wondered this. Is it an age thing or a generation thing that you've got the 55 plus audience primarily owning gold? Is that because they were born in a certain decade, or is that just because they've become 45 plus?
Yeah, I think it's both. Yeah, to what degree each, I don't know. If you've been on the earth long enough, you've experienced some degree.
Because I'm just wondering, maybe the young people today in 20 years, they're just naturally going to go on and buy gold and silver, or maybe not. Maybe it's a cultural shift in the next 2 decades. I don't know. This is a big question.
Yeah, you're right. Yeah, I'm not sure.
Any final word for the audience about why we should be owning gold today?
Yeah, no, again, great question. I think that, if you're already in the market, not a bad time to be in the market. If you're buying gold and silver, I always say just be mindful of who you're buying from. You obviously want to buy from a reputable dealer that's been around in, various market conditions. I think that's important. But also look at your fees and premiums and your spreads. Okay, so you want to again, invest in the metal and not that premium. So those are things that I look at kind of from when I'm buying precious metals. I want to buy from a reputable dealer and buy at a good price. So those are certainly the two things that I kind of tend to emphasize.
There's a lot of bullion dealers out there. What makes you unique? What's your strategy for differentiation here?
Yeah, so for OneGold, I think we're unique in a variety of ways. So you could look at it a few different ways. For OneGold, I think it's unique because it allows retail investors to buy kind of at those what were traditionally wholesale prices. So you can invest at pretty thin spreads. And you could also utilize some modern investment tools. So I think that gives you a real advantage, even if you're not in the market. You could check it out. It's onegold.com, or you could download the mobile app in the App Store or the Google Play Store. Again, even if you're not in the market, I think it's a good source to market. We provide regular market updates, custom market news, and things like this. So yeah, certainly check it out.
Thank you very much. We'll put the links down below. So make sure to follow Levi and OneGold there. Appreciate your time. Appreciate you updating us on gold.
Yeah, thanks, David.
Thank you for watching. Don't forget to like and subscribe.